Welcome back to our channel. Today, we're discussing the alarming resurgence of 8% mortgage rates and its impact on an already complex real estate landscape. The housing market was already painful, ugly, and anxious, but now, there's an added layer of complexity. The 8% mortgage rate has made a comeback, and it's causing quite a stir. Today's housing market is a toxic mix of high mortgage rates, soaring prices, limited supply, and unexpectedly robust pent-up demand. It's a situation that's leaving both buyers and sellers on edge. High prices were already a challenge, driven by unprecedented demand during the peak of the COVID-19 pandemic. But now, with the 30-year fixed mortgage rate hitting 8%, the highest it's been in decades, the housing market is getting even tougher. Mortgage demand is plummeting to levels not seen in nearly 30 years. "I think it's painful. I think it's ugly," said Matthew Graham, the COO at Mortgage News Daily, in a recent CNBC interview. The situation is far from ideal, and many are feeling the pressure. During the initial years of the pandemic, the Federal Reserve dropped interest rates to zero and flooded the market with mortgage-backed securities, resulting in record-low mortgage rates for 2 solid years. This fueled a buying frenzy, with home prices skyrocketing by 40% from pre-pandemic levels. However, as inflation surged, the Fed began to raise rates, ironically making the housing market even more expensive. Typically, when rates go up, home prices should go down, but this time, it's different. Unlike past housing crises, this market faces another challenge: a severe shortage of supply. The 2008 Great Recession and subsequent foreclosure crisis hit homebuilders hard, leading to a decade-long period of underbuilding that has yet to be resolved. Would-be sellers are in a bind. They are reluctant to trade their current 3% mortgage rates for the newly high 8% rates on a new purchase. Sales of previously owned homes in September dropped to the slowest pace since October 2010, according to the National Association of Realtors. But this time, the situation is different. Foreclosures are low, and homeowners have accumulated substantial equity. So, where does this leave potential buyers? Many are feeling anxious and are adopting a wait-and-see mentality. They are reluctant to enter a market characterized by uncertainty. The NAR is now lowering its 2023 sales forecast, with a potential decline of up to 20%, compared to the previous 13% estimate. Despite the challenges, some markets with faster job growth and affordable prices may see an upswing in sales. Florida markets like Tampa, Jacksonville, and Orlando, as well as Houston and Memphis, could be exceptions. The silver lining for buyers may be in dealing with homebuilders, especially larger production builders like Lennar and D.R. Horton. They are working on affordability by lowering interest rates for their customers, a tactic they haven't used at this scale in the past. Although single-family home construction is increasing, it's still not enough to meet the demand. Builder sentiment is declining due to higher rates, but the new home market remains more active than the market for existing homes. On the bright side, apartment rents are finally cooling off due to a surge in new supply, giving renters less incentive to jump into buying. Demand for rentals, on the other hand, is on the rise. So, if you're looking to upgrade to a larger home or downsize, you're caught in a dilemma. Prices are still rising due to supply and demand imbalances, but sellers are becoming more flexible. You can buy now at higher rates, hoping for a price break, or wait for rates to drop. But be prepared for potential bidding wars when they do. That's the current state of the housing market, a complex, ever-changing landscape that's leaving many in a state of uncertainty. If you found this video informative, don't forget to like, share, and subscribe for more updates on real estate and market trends. Thanks for watching, and we'll see you in the next video.